Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by FounderSuite.com. Today I have Dave and Jonathan of Postie coming to us from LA and San Diego. How's it going, guys?
It's going great.
It's great.
Great. Glad to have you guys. Interesting story about your business. Tell us what is Postie and where'd you guys come up with this idea?
Yeah, so for those listening to the podcast versus watching the screen cap, this is Dave. Postie, the one sentence elevator pitch is a data and technology platform that makes direct mail marketing behave like a digital channel. And so Jonathan and I, and really the core team here at Postie, we come from a long history of building direct-to-consumer brands, as well as ad tech platforms that leverage performance marketing, quant-data-driven marketing throughout kind of the rise of the internet here. And we love data. We love kind of the predictiveness that it allows for us to grow the business we've been involved in. And over the last handful of years, as many of the DC brands and founders listening may relate to, the programmatic marketplace channels like social and search have become much harder to find scale and efficiency as those marketplaces have developed. And so the story with Postie was a really inorganic one, which is we needed ways to kind of move from solely in digital from a marketing focus into more omni-channel, but we expected the same use of data and measurement and quantitative tools. They didn't really exist. We fell in love with the direct mail channel. And we wanted to get more aggressively focused there, and so we ended up building the tool set needed to run that channel like a true quant digital channel.
Interesting. Isn't it amazing how I used to get just a stack of mail every day, and now I get 2 letters in the mailbox. Right? It's become this open channel, whereas it used to be very cluttered and crowded, which I assume is something you're obviously tapping into.
And it's interesting because if you think about how many ads you see online in a given day, it's saturated, right? And yet people see everything that's in their mailbox. And so if they get a quality piece from a really good brand that's well designed and it feels good, the paper is good, all those things add to the effectiveness of getting a piece of mail.
And so how does it work in practice? A company, are you targeting larger businesses, CPG brands, or is it small businesses across the spectrum? What's target, customer, and how does it actually work? They sign up and create some creatives and start doing mailers, or give me the kind of use case.
Sure. So the direct mail channel has proven to be effective for really the full scope of marketers, D2C, B2Bs, small businesses, big Fortune 100 brands. Postie in our current state focuses on a fairly bifurcated market. So we are heavily focused on catering to what we call the digital native brands. So these are the meal kit delivery companies and the men's grooming companies and the fashion brands that have evolved over the last probably decade or so. They tend to be very quantitative in nature. They've mastered Facebook, they've mastered search, they've mastered email, and they probably have either just started experimenting with direct mail, or have stayed away from it just because of the kind of analog, antiquated nature of what the executional aspects of direct mail look like. So that's one lane that we drive through. On the complete kind of the opposite end of the spectrum, we also cater to the biggest Fortune 100 companies out there who are spending tens of millions of dollars annually in direct mail. They've been running their programs the same way for the past 20, 30 years, and they're looking for innovation as well. They've all adapted a much more dynamic and data-driven approach to their digital efforts. And now they're looking and saying, well, why are we running some of our biggest media channels like direct mail in such an antiquated, slow fashion? And so they gravitate to our platform as well. Jonathan, do you want to walk through how it actually works?
Yeah. So kind of one of the most valuable things that we provide is new customer prospecting. And so a business will have a list of existing customers, and they'll sign in a Postie, they'll upload that list, and our machine learning stack will use a bunch of data from just a multitude of sources to build a lookalike model from their existing set of customers. And so then they can decide after that model is built, how deep into the model they want to mail. So, based on budget and reach and kind of their business goals for that week or that month, they mail that lookalike audience. And so what we've done here is we've made something that performs at the same speed as a digital channel. So people are used to going on Facebook, building a lookalike model for their, from their customers and being live same day. And so like by using a modern machine learning stack and modern data sources, we're able to take something that either wasn't able to be done before in direct mail or would take, 6 or 8 weeks of manual work. And, we can do it in a matter of minutes now, and then be in postal, in the post office same day or next day. So really that speed to iteration helps people kind of stay engaged with the channel and stay creative and, test and optimize all the time.
And is it kind of like analogous to like a drip email campaign where you create a lookalike audience, create some creatives, and then I as the recipient would be getting a series of offers, postcards, something like that until I engage and drives me back to the website? Or how's the loop get closed?
So advertisers, they can design whatever sort of, engagement stream they want. So frequency is really important. So if you want to tell a story through multiple pieces, that works. Some advertisers want to send more people, but less frequently. And so we really give the tools to the advertiser to test and optimize and kind of zone in on what works for their business.
And I think one of the questions that you asked is kind of the specific marketing objectives. So direct mail is one of those unique channels that allows you to hone in and tackle really the entire life cycle of marketing. So we think about breaking that up into 3 different kind of distinct buckets. Sometimes it's run by the same team, sometimes run by multiple teams in a brand. And that starts with top of the funnel prospecting, which Jonathan focused on. So the holy grail for marketers is how do we just find more high-performing customers in an efficient manner, and direct mail historically, and certainly through Postie, has proven to be incredibly effective and scalable. The other end of kind of the marketing life cycle would be driving lifetime value extension and monetizing and maximizing the revenue and engagement from your existing customer base, as a brand, you have a wealth of data and knowledge on how those individuals are engaging with your brand, products, services, etc. And direct mail is incredibly effective at allowing for segmentation and deployment, whether it's scheduled, dedicated deployments, or whether it's as you asked about dynamically generated daily drip, what we call trigger campaigns. So behaviorally generated audiences because someone took this action on your website or purchased this specific SKU or hasn't been seen back transacting with you in 60, 90 days, then send them this piece or series of creatives. And there's a ton of nuances kind of in between those two the buckets, third being what we call retargeting, which is kind of everything in the middle. So using your first party non-transactional data in order to drive engagement, whether that's retargeting or lead conversion campaigns. And in the digital world, there are very few channels, if any, that allow you to cover, the full spectrum of lifecycle marketing. It's one of the core reasons we fell in love with the channel.
Yeah, no, it's so funny. Like I said, it was such a thing before, and I feel like it was sort of left for dead. And now it seems like companies are kind of rediscovering, direct mail, which is interesting. Like I thought of you guys yesterday. We switched our our email service and off of HubSpot, and I logged into what we used to use, MailChimp. We haven't used it in a couple of years. I logged in yesterday for the first time, and one of the first things that pops up is a little blurb to send a postcard to a physical postcard to anyone we have a physical address. Like, it was kind of interesting how people are obviously paying attention to direct mail again, and so the trend is clearly there. Yeah.
One of the really compelling statistics that we've seen across campaigns and across all our verticals is that the most responsive group of people to direct mail is actually the 20 to 30 year olds. So it works really well across demographics, but there's this kind of perception that it's an older media channel, and so it must convert, for older demographics, but not for younger. And that's not actually the case. There's something about that 20 to 30 year old demographic where that physical, holding something physical really is impactful.
Interesting. Well, I could spend a lot of time because I'm just fascinated by the business, but let's get into the fundraising discussion. How long have you guys been around? When did you start this?
So the business started officially January of 2017. So we're almost just past our year and a half birthday. Relatively new company, but we've accomplished a lot in a short period of time.
Cool. And how much have you raised? How many rounds?
Yeah. So business was self-funded initially, and we just took our time. Jonathan and I are fairly experienced entrepreneurs at this point, and we wanted to really prove product market fit, convince ourselves that this vision of turning the direct mail channel into a true dynamic, fully automated channel was possible before going out and raising money. And that's pretty different than I think the kind of standard flow where entrepreneurs will try and get seed funding as early as possible to de-risk. We just took the opposite approach. And interestingly, it took us a long time to finally decide that we wanted to bring in external capital. There was always this fantasy of, could we be one of those transformative companies that never takes capital? You mentioned MailChimp, right? A company allegedly $500 million of revenue, highly profitable, never took external capital. That's pretty extraordinary. And so I think that would have been the ultimate fantasy. Not always possible in every business model. And so exactly a year ago, well, actually 13 months ago, we did end up taking some capital. We raised $3.5 million in a seed round. And we did so where the majority of the round was split between two, longtime relationship-friendly institutional funds here in Los Angeles, and then we carved out a chunk of equity for some very strategics who had built and sold and scaled businesses that were similar to Postie that we thought would add a ton of value.
Now, for previous companies, had you raised venture before? It's always an interesting question because sometimes people are either they love the venture model, or I talked to a lot of founders who raised money before and they would sell their kid before raising money again from VCs, right? It's kind of like, depends on your experience. So
yeah, and we're somewhere in the middle. Our experience raising capital has generally been very positive. It just comes with a different set of expectations and challenges. And raising money for raising money's sake is never a good thing. You want to have a strategic reason to capitalize your business. Every business just about every business, I can think of one exception that I've been involved in my career, which has been the better part of 16, 17 years now, took on capital, and in most cases, extraordinary amounts of venture from traditional funds. And they grew quickly, and some were successful and some were not successful. So this is a more unique, I think, path to execution and growth for us. Yeah.
And I would say it's really important to focus on like that first part of the business where we were just completely completely focused on making sure that the metrics of the business were good before we went out to raise money, because like we didn't want to raise if it was going to be a bad idea, right? And we didn't want to raise if the business metrics weren't solid, right? And so kind of that initial focus, I think, has served us really well in this business.
So you spent a year kind of proving, building an MVP, proving the model. I guess you don't have to share exact specific numbers, but kind of what were your metrics you were tracking and then putting forth into your narrative? What were you pitching?
Yeah, so I think there's kind of two types of data points that we were very in tune with, and those were really qualitative on one side and quantitative on the other. So on the quantitative side, it all started with margin. You can always scale a business. There's always ways to generate new customers and revenue. But if you're onboarding bad revenue because the margin is not great or it's too expensive to acquire that customer, and so your CAC to lifetime value ratio is not there, then you can look at a path where maybe you could be a revenue story, but you're never going to get to break even or profitability, and that's where ultimate terminal value comes more times than not. So for us, it was really first and foremost getting all of the supply attributes locked down, so understanding exactly what we needed in order to deliver our service and product marketplace, what the cost of generating revenue would look like, and in our business, it comes from its team, kind of the general and administrative costs. So team, we're really a technology platform, so engineering and data science and sales people and account managers. And ops people. There's hard goods. We're printing and deploying mail. We're leveraging both platform and third-party data, so there are costs associated there. And some other obviously costs that go into servicing a campaign. Once we had a really good understanding of the high, low, and kind of median range, margin range, that was step one. Step two was getting very familiar with what are the size of the average transactions? What does a client in the range of clients that we engage with spend a month, or could they spend a month in direct mail? And that helps us understand what the potential monthly, quarterly, and annual margin per client looks like. And then the third piece was, does direct mail work? Is it our whole philosophy is we want to make it very transparent on what your ROI, your ROAS, your CPAs look like, and so we needed to prove to ourselves that mail with the cost basis and our methodology on deployment, targeting, optimization could actually drive ROI for our clients. So those were the things that on the quantitative side that to us were just so obvious, and also made, I think, fundraising very easy, that we proved those out and that we understood those business principles. And then on the qualitative side, it was just simply, how do people respond to having a technology solution for this channel? How engaged are quant marketers in and how much capacity, mind share, risk tolerance do they have to test a new channel, and this channel in particular? And so all those things became abundantly clear over that first several months, and we knew we had a good business. We hadn't figured everything out yet, but we knew that we felt in control of the business, and I think that was really the moment that we looked up and said, it all tends to work. All the data looks generally good. We need to get it better, but taking on some strategic capital, de-risking, and being able to accelerate our growth, really through hiring more than anything, made a lot of sense.
No, it's impressive to do all that in a year. I mean, a lot of companies spend years and don't have that data. How many pilots do you have to run to kind of have like statistically, relevant and accurate data like that, or metrics like that? I mean, because that's not easy. That's non-trivial.
Oh man, I wish I knew you were going to ask that question. We would have brought some of our PhDs on the call for the complex math. But look, for us, it was in the early stages directional. We could have gone a lot longer before raising capital, and And I don't think that running another 20, 30, 40 campaigns would have returned any different data. So for us, I'm going to give you, without having the dashboard up in front of me, and we had probably sent
a couple hundred, I think. 1,000 maybe? Like 1,000 maybe?
1,000 campaigns. Yeah, and obviously, millions of pieces of mail, across a good dozen verticals. And and so it was a real business. We were doing real revenue. It was growing substantially month over month. Really right from the get go. And so we felt very confident in again, not that we had solved every problem, not that we had every feature that we wanted live, but that we had a statistically significant amount of data to suggest that A, the channel works, and B, we have a good grasp on the cost side of our business.
Very interesting. No, that's amazing. Cool. So talk about actually the fundraising process. If and we can always cut this out if you, but I believe it's public knowledge. Crosscut and Bonfire Ventures are the two firms that led the deal.
That's correct. Yeah, that's correct. And both great partners. Look, our fundraise was slightly different, right? So Jonathan and I have been involved in growing businesses here in the LA ecosystem for the better part of a decade and a half or so. Both Bonfire and Crosscut were had individuals and partners that we had relationships going back 14, 15 years with, who had invested in other companies that we had worked for or built. And it was and they were with us from the start. They were the two firms that originally came to us when they heard that we were working on something. The truth of the matter is, to them, at least for the early conversations, it almost didn't matter what we were working on. They wanted, they made it very clear they wanted to be supportive, involved, and honestly, in both cases, they didn't show up with term sheets, but they more or less made offers on the spot. And I think they appreciate the fact that we said, look, we're not there yet. We're still trying to figure out the nuances of our business. And it really was a kind of a 6-month, drawn out series of just authentic conversations. And at one point we turned into more of a formal process. We were heading back up into your neighborhood and sitting down with the firms. We had a ton of attention. It was very flattering. And then eventually, when we decided where we were as a business, and the type of partners and capital that made sense for us at that stage, we decided to stay local. And it's been great. We have friends who are rooting for us every day. They're there for us when we have questions and we're tackling problems that maybe we hadn't seen before. And so for us, it definitely has proven to be the right decision.
Yeah, I was going to kind of ask that. You've pretty much already answered my question, but when you have these VC firms that are kind of already friendly to you and want to see what you're doing next, like the temptation must be kind of strong to go take that interest, shop it around, see if you can leverage that into a Andreessen Kleiner Sequoia type of deal, or do you kind of just stick with the familiar, tried and true, and build on that loyalty? I don't know if that.
Yeah, no, it makes perfect sense. And we did that out of fairness to us. We didn't run a formal process where we went out and shopped 40 firms, but we sat down with 10 or so. They all were firms we had pre-existing relationships with. Many of those that you named in your last sentence were included. We had lots of offers, and one of the things that we want to do is to, out of fairness to us and investors in general, kind of understand where the market was setting both valuation terms, and that was important to us to make sure that we were. You only get to do a seed round once, and you don't get to go and reset it, and so terms matter. Probably more so than valuation, but both mattered to us. And so we had to go and have some conversations to put it in perspective. I mean, there was a an offer on the table with two absolute top marquee firms that were going to split a seed round. It was going to be a larger amount of capital, and it was sexy. I mean, it was the type of things that entrepreneurs dream of. And Jonathan and I struggled for a while, and we finally looked at each other and said, "This is crazy. Like, why are we bringing these two firms in for a seed round when we're going to need them at a later date when we get to the growth rounds?" And it's a lot of unnecessary pressure, and we just wanted to be able to kind of take our time and build a great product and the foundation of the business rather than focus on just absolute rocket ship like growth. When we came back and we turned down some of these other offers, I think in particular because even at the marquee firms, they were their friendlies, they all kind of smiled and said, "You did the right thing."
They said what? You did the right thing?
They said you did the right thing. They said it was like, we're cannons and you didn't need us right now. Come back to us.
We're cannons. That's interesting. I've never heard that. It makes sense though. Let's talk about that for a minute though, kind of riff off that just a bit, because it seems like, again, my MailChimp experience yesterday, logging in, seeing them promote the postcard, or I guess there's some other players like Pebble Post that have raised a bunch of money. Do you feel that it seems like the space, my point is, it feels like the space is kind of heating up, getting, some attention, getting some players involved. Does that compel you to want to raise a lot quickly and fire those cannons? Like, how do you think about that?
So I'll give you my perspective. Jonathan may have a slightly different perspective, which I think is always good. I mean, not really. I'd be lying if I said there weren't moments of like, oh God, should we be moving faster? Are we being too precious? That's just natural, right? And I think like all good entrepreneurs, we have our moments when we think we're the greatest thing in the world and nobody can touch us, and then we have moments where we think we're complete failures and we'll never accomplish anything in our careers. I mean, that's just maybe even more extreme with us than most, but I think that's pretty natural. So sure, there are moments when we look and we just know what we could do with a ton of capital, but at the end of the day, we're building a product that is quantitative in nature. We work very hard servicing our clients transparently and putting in a ton of effort to making things easy, helping them accomplish the pain points that we as marketers had, which is what led us to build this product. And they realize at the end of the day with quant performance marketing, and really, that SaaS, platform like Postie that supports it, either you deliver results or you don't. It doesn't matter how much venture dollars you raise. If a brand jumps on the platform and the tools aren't easy to use and they're not getting results and they're not accomplishing their marketing objectives, it's irrelevant. And so, we look at it and say, sure, we raise a bunch of money to go toe to toe with the sales organization. We ramp from 10 to 100 salespeople in 6 months, and it's just not where we're at right now. It's just not us, and and I don't think it's necessary. So there are businesses where you just can't, you don't have a choice. And an example is, and we look at it for parallels and analogs in all sorts of completely disparate and similar and competitive businesses. You look down the street here, kind of one of the big transformative LA companies is Bird, the scooter company, right? Like they're competing with Lime. They're competing now with Uber. They're competing with Lyft. They need to raise ungodly amounts of money, and they have no alternative. They don't get to say, we're going to build the best app and the best geolocation and proximity data, and we're going to make sure that our scooters have better gripping foot pads, and that's going to get rid of that. They just don't have a choice. It's an all-out war. We're not. We're just not in that type of space, and that's I think a luxury for us.
And I would actually go back to your example of MailChimp. Just incredible product all around. But they're something like 16 years into that journey, right? And so, capital does a lot of things, but it doesn't automatically make you an amazing product, right? And so, like we're really focused on the product, like Dave's saying. And, if we had 10 times the capital, would we have 10 times better product? Like, no, like we're still in that stage where we're just, we're building amazing product. And I don't think a huge raise at this point would have helped that.
That makes sense. Yeah, makes a lot of sense, right? You can't just add 10 more engineers and make a 10x better product.
No, I mean, you add 10 engineers and your product quality likely goes down, right?
Yeah.
Unless they're exactly the right people. And so far, like our engineering team is amazing, and but we're very capital efficient and very focused on that.
Well, and this is a kind of a broader topic, but like, constraints often make you focus, right? It makes you focus on what is the 2 or 3 killer features that your customers need versus 20 features that you pack into right. Constraints kind of create creativity and also focus, and you're not in maybe a winner take all market like Lime versus Bird. So, maybe you have a little more freedom. So that's interesting stuff to balance, right? These are the fun trade-offs and things, entrepreneurs have to sort out.
And Jonathan and I have these debates daily.
Yeah, we might change our mind tomorrow.
Yeah. We'll see a $50 million Series A round. Yeah.
But look, like, let's be honest, like to be able to figure out what trade-off is the right one to make, like, I mean, we're lucky to be in this industry and to be able to do that. So.
Yeah, no, good problems to have, whether you take the top tier, term sheet from Silicon Valley VCs or stay local. I mean, these are great problems to have. Let's see. So I wanted to touch on something that you mentioned before we started recording, just on controlling the narrative. Like, as you're, building this out, I'm sure you'll be raising money again soon. How do you sort of think about controlling the narrative when you're talking to investors?
It's a great question, and it's critical. As entrepreneurs, I mean, the biggest advice I would give them is that never lose sight over the fact that this is your company. You had a vision. Hopefully your vision came from a problem and your belief that you had the capabilities of developing an elegant solution for it. And first of all, Jonathan's great at reminding me that anytime I'm having kind of a freak out moment, usually I tend to wear my heart on my sleeve. I engage with all of our clients when there's a single campaign that isn't executed with perfection or didn't deliver the ultimate, results we anticipated. And someone, maybe less than over the moon, which very rarely happens. But when that does, Jonathan always reminds me, he's like, look, we're getting up every day and we're working 14-hour days to try and solve pain points that real marketers have. And that doesn't mean perfection. It's test and optimization marketing here, which means that not every campaign is going to be perfect. And I think that same narrative carries forward when you're sitting down across the table from people that are grilling you on your business and trying to poke holes. I mean, their entire job is to try and find every reason they shouldn't invest. And it's really easy to walk away feeling dejected or, they point out another potential thing that could, fail in my business. Well, there are a million things. I say it all the time. It's like, look, everybody gives us tons of compliments about how much we've accomplished in this short 1.5 year period. And I always remind them, like, look, we can screw it all up really quickly, and it's ours to make sure that we don't. But sitting across the table from a group of super intellectual, smart people that are, again, their sole mission is to try and figure out every reason they shouldn't invest, so that at the end of the day, when they finally make an investment, they feel like they've done everything they can to de-risk their perspective. You really have to come in knowledgeable about your business, understanding the data with absolute clear transparency and knowledge over why you're raising in the first place. You're hopefully raising not to survive, but you're raising because you found something that works and you know how to accelerate that business with additional capitalization. And that comes from kind of the questions that you had asked earlier in this conversation, which are, what KPIs are you using to determine whether your business is on the right track or not. Understanding the actual margin structure of your business is absolutely critical. And many early stage first-time entrepreneurs lose sight of that and they focus on revenue. Certainly understanding and having some control over the growth of your business, understanding, some tactics that are driving new customer engagement, and understanding the cost of that, and then being realistic over, with yourself on, does the same efficiencies you're seeing hold with scale? And if yes, great. And if not, what do you have to do to try and drive efficiency as you scale? As you understand those things, it doesn't matter how smart or experienced the person sitting across the table grilling you is. You know your business better than them, and you just have to. It's always good to be mindful and listen. And some of those pitches are great because you're sitting in a room with people that have lived the war with many successful and unsuccessful businesses, and probably have some insights that you don't have. But again, your business better than anyone else. If you understand the data on the cost side and the growth side of your business, you understand your product vision, and you can speak very clearly to it, then you 100% have the confidence to control that narrative as you're presenting, and not get kind of taken off track by the fear that the fundraising process can potentially impose.
Good. Jonathan, anything to add on that?
Just one thing on investors, like they've seen a lot. And so just this morning, we were actually remembering some advice that an investor gave us that turns out to be spot on. And it's not someone that invested in the company, but they gave us some feedback and it turned out to be right and, really, really good. And so there's something about the fundraising process that it can actually be this great learning experience where you're sitting down with people that have seen so many data points. They've seen so many stories play out. That there's a lot of learning that can take place there besides just like this, raising of capital.
Yeah. I was going to ask that question. Do you guys actually kind of have a set of questions that you guys usually will be asking the investors during these meetings? You're trying to kind of extract, learnings from their brains, or is it more just informal?
It's a really good question. I think it's a little bit of both. These are human beings that you're engaging with, and you're having a dialogue. And so those conversations you want to keep, we talked about controlling the flow of information, but you also want to be open to kind of going down certain rabbit holes that make sense based on the knowledge of the person on the other end of the table. As I'm saying this, I mean, probably the biggest piece of advice that I think we can give people going into funding processes, that again, these are human beings. These aren't logos, right? And so, everybody gets excited. We're going to meet with Andreessen, we're going to meet with Excel. That's not the case. You're going to meet with one or a series of individuals at those firms that each have distinct, disparate insights, information, background, knowledge, experience, etc. And so if you do your homework going into those meetings and you understand the operational roles that they've been involved in, the investments that they've made, those that they're spending most time on, you due diligence them with investors or with entrepreneurs who maybe they're sitting on boards with, then I think you can go in very prepared, both on your own pitch, but more importantly to the stuff that Jonathan was talking about, which is you can extract value from, even if you're given an hour with these incredibly insightful people, and gain feedback. And sometimes it's major, and sometimes it's minor, and they're macro and in nature, or micro. And the example that Jonathan's referencing was simply about us doing a very casual reference on an exec that we were bringing on board, or thinking about bringing on board about a year ago, and getting some really insightful commentary on all the positives of this person, but also there was one very specific this is maybe their weakness, where you need to help develop them. And that's true, as Jonathan said, that's proven to be incredibly insightful, and has, where you may have started doubting or questioning this individual, it became very clear that, hey, no, this is a really key, awesome executive. We just need to help this person, and with this one area of skill that he or she has not been able to develop yet. So yeah, I guess that's a long way of saying that do your work, be prepared, understand the expertise of the person that you're getting the luxury of spending some time with, but then be open to where they take the conversation as well.
One interesting thing that we found also is, like, we're going into investors pitching this new channel for growth, right? Or this remake of an old channel. And so the number of referrals that we've gotten from investors that aren't even, in the company are, like, it's a pretty good number, because, like, they all have portfolio companies that need help with growth, right? And so, just that process alone, or that part of the process has been beneficial.
Yeah, I had that with another of these interviews, a company called BotKeeper, which is doing like an accounting, AI-driven accounting, and they were getting a ton of customer referrals from the fundraising process, and they're kind of like, maybe we should continue our fundraising, like a sales channel. Yeah, it's pretty interesting. Actually, I had a question drilling into something you mentioned about kind of diligencing the investor you're going to be meeting with by talking to other founders they've invested in. Do you ever do that before the meeting? Do you ever talk to other founders kind of prior to meeting with the investor, or is it usually after a meeting or two?
No, as often as possible. I mean, it would be hard to say 100% of the time, but we're at the very least we're doing kind of the written research due diligence, and then as often as possible, we're trying to connect with individuals who know these people. And sometimes it's another investor that's co-invested, and sometimes it was the boss of this investor at a company that they worked for when they were operators, and sometimes it's a portfolio company. It's critical. You don't get a redo, really.
Yeah.
Once you have a board, and there are elected members of that board, and once you have you're sharing the cap table and that your equity with other individuals, you don't get to say, oh, we're not such a good fit for each other. We're just going to buy back your shares.
Yeah.
It doesn't work that way. At least not often. And so, it's a long-term relationship. And the other thing to note is that there's, the terminal value of a company is something that, most, entrepreneurs and investors share in common, but not always. And certainly not every step, between the day that check clears and that day that you reach terminal value. And so the minute that you have someone that has a say in your business, it means that the trajectory of your business could be changed forever. And you darn well better do your due diligence to make sure that it's not just about the money, but it's about people that share that value, that are going to add vision and value, are going to be supportive, are going to kind of let you make some of your own mistakes, and provide guidance when it's critical. And not all investors are good at all those things.
Yeah. Okay, one or two more questions, and I'll let you guys get back to building Postie. Kind of a tangential question I've never asked before, but do you guys tag team your pitches? There's obviously two of you on the podcast. Usually these are just the CEO. Do you guys go in and how do you break up a pitch between the two of you if you do that?
How did we do that? So most of the pitches, I think I would run demos, and Dave would do a lot of the high level. I don't think you want to tag team too much, though. I mean, it's important to kind of see both of the founders, but it doesn't need to be like a circus or anything.
Yeah, I mean, look, Jonathan and I mean, we have the luxury of having worked together for 50 years in pretty intense entrepreneurial projects. So we knew what we were getting ourselves into when we decided to partner up on this business. That's super helpful. I think it would be very different if we were kind of a match made, between a business mind and a technologist, and we're just trying to build something and had known each other for 3 months before we went out and raised. we tend to complement each other very well, and we split. I think division of responsibilities very clearly. Jonathan is the CTO, I'm the CEO, so the business units roll up under me. The data science and engineering orgs roll up under him. We share product, and I think a very clear collaborative vision on product, where our product really comes from a providing a solution. It's not it's not some just crazy idea we had. We recognize the problem, and we're trying to use technology and data to solve that problem. So I think in our pitches, we certainly did some practicing, and there are just there's not a whole lot of dead air time when questions come in, looking at each other, wondering who's going to take them. It just we know where that line is, and it works well. So for founders that don't have that same chemistry, it probably does require a bunch of preparation, mock pitches, very detailed outline, understanding whose expertise or what categories each founder's expertise falls within. And in some cases, it probably is easier if just one of the founders is the one leading the conversation in a pitch. It wasn't really the case with Jonathan and I. I think I probably took most of the lead, but it was very collaborative.
Did we ever answer questions in perfect unison? That would be a good trick.
It wasn't perfect unison. We harmonized.
Oh, harmonized. Okay, that's good. That's good.
Good stuff. All right. Last two questions. Any tips just for founders in Southern California, kind of navigating the LA/San Diego startup or fundraising ecosystems? Where would you point them to get going? Anything there?
Yeah, so I can't really speak to San Diego. Jonathan can speak a little bit, I think, more broadly there. In LA, look, we've hit our adolescence in the startup cycle. So I think the number one thing that you see is that there's more people that have batted through the cycles. Silicon Valley, because they started 30 years earlier than anyone else developing technology and startups, and so you have lots of individuals who are 3, 4, 5 generation old, right? I mean, you see the PayPal mafia, as they call them, and they're all on their second, third, fourth, fifth, sometimes doing apparently like 11 startups at once. And there's the amount of knowledge and expertise is tremendous. You don't get that by reading a book. It helps, and blogs help, but you get that from living through it. And in LA, there was a time when everything was MySpace, talking about just MySpace, and there was this one kind of transformative company. We're at a different place right now. There are now multi-billion-dollar, meteoric rise consumer internet companies that are popping up regularly. Bird and Snapchat, to examples of that. And so what that means is you have a wealth of knowledge on things like fundraising. People that have gone through it and raised hundreds and billions of dollars in funding. You have product people that have lived through the woes over a couple decades now of building and pivoting and optimizing. You have the quants who understand data and all the signal to indicate that it's worth continuing to invest in this or not worthwhile. And then it's just more money too. So you don't have to leave LA. It used to be that you could raise a $500,000, $1 million seed round in LA, and then you were forced to go up north. It's still a good idea because there's very smart investors up there, but you have a lot more surrounding opportunities here. So what if I was just moving to LA or graduating college and wanting to get involved in a startup, it's a great town right for networking, and there's no shortage of networking events, and there are no shortage of people you can LinkedIn stalk and take for coffee dates, and we're just in a time where there's a lot of activity and people are excited to talk about it. So that's I just think it's a really interesting time for LA, and not just LA, New York and Chicago as well. I don't think anybody's kidding ourselves in saying we have the same wealth of knowledge that San Francisco, it just would be impossible to catch it right now. But there are lots of entrepreneurs, engineers, product investors who have lots of wins and kind of bumps and bruises from their experiences. So just get involved, network.
Yeah. I agree with you. I think LA is definitely on the ascendancy. And I mean, just from our perspective, we sell software for startups raising money. And I see a ton of action down in LA, both from our customers, but also just different incubators, accelerators. Like there's a lot going on in Southern California. I'm kind of blown away. It's like Austin and LA are almost like kind of, I would almost say, you know, battling for, I don't know, whatever, number 2 or number 3, or I don't know where you put New York on the thing, but it's like definitely a lot of cool stuff happening there.
Yeah, probably depends on the vertical. Each city tends to have certain characteristics that they're better at.
Yeah. All right. Last question. Any advice you would give your younger self if you were doing this all over again, or any other advice we haven't touched on that you want to get out?
You want to go first, Jonathan?
Yes, I would love to go first. Probably the biggest piece of advice is in that initial period of bootstrapping the company, of self-funding, would just be to kind of zoom out and see the bigger picture. It would be hard to actually do this, but don't stress about things in that initial period, but just kind of enjoy the freedom that you have to explore, this new business opportunity and focus on the fundamentals. In many ways, I think we really did that period really well. But it's a stressful time, to just tell ourselves to kind of enjoy the freedom that kind of fluid period of the business lets us have.
That's good. Yeah. Tell yourselves to chill out a little more, right?
Yeah. Still be impatient and want to build amazing things, but to kind of recognize where that period fits in kind of the history or the story of the company.
That's interesting. Yeah.
And I think for me, there's a million things that I would tell myself to do differently. Part of being self-critical, but that's kind of, I think that's really, what I would change, which is just kind of maybe whisper in my ear that don't be so afraid of failure, move fast, get yourself out there. I think in my early days, I was even more self-critical than I am now. Felt like I needed to know all of the answers before making decisions. And I think, to be quite honest, to be an entrepreneur, you have to be able to make, definitive decisions with imperfect information. Look, if you're building something from scratch and trying to be disruptive, it's because nobody's done it the way you've done it before. So how can you possibly have all the answers? Yeah. And that, I think, leads to more success. And you just have to, you just have to be okay with the failure in order to accomplish the successes you're going after.
That's good stuff. I mean, I think kind of a corollary to that is like making decisions without perfect information. Rarely are decisions ever permanent, right? You can fix things, you can pivot, change, and failure is just part of the whole process with entrepreneurs. I like that. Okay. If people want to learn more, is it just postie.com, or do you have an unusual domain?
No, you got it. postie.com.
Anything you want to plug? Anything you're hiring for? Any specials or deals you've got running? Anything you want to plug?
So certainly, I mean, look, we're very selective in the talent that we onboard. We care a lot about culture and strength of capabilities. We're always looking for strong difference makers on our engineering team and our data science team. Certainly on the business side, we're looking for strong, motivated salespeople and quant marketers. So one of the kind of differentiators, I think, about how we build our CS team is we're not hiring a bunch of CS people. We hire quant marketers, people who have been optimizing paid media campaigns for a long time. So if you're looking to jump onto the software side from maybe running marketing in a consumer brand, we want to talk to you. And then as far as plugging business, if you're a direct-to-consumer brand who feels like you're fairly saturated in your current channels, thinks quantitatively, and has either been frightened by kind of the antiquated nature of direct mail, or has heard maybe there's something there and it works. I can tell you with 100% certainty, we have direct access to the data in every single campaign. It's a great, highly effective, big scalable channel that performs on par by all metrics to any of your best digital programmatic channels. Come talk to us. We'll we have lots of case studies and knowledge to share, and we have software and a technology platform to make it easy and possible for you to tackle this channel fearlessly.
What's a minimum spend or budget that you should have in mind before coming?
Yeah, it's a great question. So we like to loosely say that it's a campaign-based platform. There is no minimum. The reality is that it's all about mathematics and statistical significance. So what we care about is two things. One, that your test cells are big enough based on your expected response rate to deliver statistically significant results. So when you're making decisions on future optimization, they're actually predictive. The other is that your budgets are big enough to test, so that you're not trying to throw bullseyes out of the gate. That's just not how any media channel works. Our clients come on board, and it's a crazy range. I mean, we have clients that come on board and spend $10K a month for a while and just getting their feet wet. They're learning much slower. And we have clients that come on board and spend $250,000 out of the gate, no problem. And the difference is that they're just learning faster. More creative tests, more audience segments, more lookalike models, more marketing tactics. So don't let budget scare you off, but come prepared to invest in the channel. It's silly to kind of just dip your toes in.
Cool. Yeah. Well, we'll be calling on you at some point. Hopefully, it'd be fun to run a campaign. So, gentlemen, thank you. This is wonderful, excellent stuff, and we'll catch you after your next round. How about that?
All right. Perfect.
Thanks, Nathan.
Okay.
Nice
Cheers, guys. Thank you.
Bye.